China's currency, much like the country itself, was for decades something of a mystery in the financial world. The renminbi, which means people's currency, was brought into being in 1948 by the Chinese Communist Party. For several decades it was exchanged at various unsatisfactory levels, until in 1997 it was pegged to the US dollar. The peg was removed in 2005 as Beijing began a process of internationalising the renminbi, but the exchange rate remained tightly controlled, with movements permitted only within a narrow band set by the central bank. Offshore renminbi bank accounts were permitted. Chinese people could hold renminbi savings off the mainland. In an effort to promote the circulation of the currency outside China, in 2009 China began allowing approved companies to settle trade payments with non-Chinese customers using the renminbi. A fifth of China's foreign trade is now settled in the currency, compared with just 3% in 2010. The use of RMB for trade payments has resulted in the build-up of the renminbi outside China. RMB centres have been established in a number of financial capitals, several in Asia-Pacific, but also in places such as London, Frankfurt, Paris and Luxembourg. Hong Kong holds most of these deposits, with 900 billion yuan, about half the global total. 5 years ago, the RMB was the 35th most traded currency in the world. Today it is the 5th biggest, although at slightly more than 2% of the global total, it is dwarfed by the dollar and the euro. China wants to take the internationalisation of the currency a step further by having it included in the basket of currencies that make up the fund's special drawing rights, or SDR. That would amount to an official endorsement of the RMB as a reserve currency. One key IMF criterion for SDR is whether currencies are freely tradable. The US has long wanted China to stop intervening to support its currency in the foreign exchange market. But most currency strategists believe that while China is committed to reducing intervention, the government isn't willing to give market forces complete free rein over the exchange rate. US complaints about Chinese intervention to keep the currency deliberately low for reasons of trade competitiveness have been around for years. But the RMB has gradually appreciated in value since 2005, save for a 2-year hiatus around the global financial crisis, although it did begin falling again early in 2014 and has kept within a narrow trade band since then. Some investment bank researchers believe further intervention will come from Beijing in the form of monetary easing. China may be the world's biggest economy, but growth is slowing as China begins the task of converting its economy from one based on investment to one focused on consumption, and the economy is suffering from deflationary pressures. Capital outflows are on the rise, and the shock sell-off in Chinese equity markets this year, which has seen the Shanghai index fall by 30% since the middle of June, has prompted some dramatic intervention by the Chinese authorities to restrict sales. The more China heads along the path of financial liberalisation, the more it will be exposed to the volatile nature of the global markets. This is a challenge that will sorely test the interventionist instincts of Beijing.